I think flows in high yield in 2015 are going to be similar to most years. That we're going to have inflows and outflows that's going to ebb throughout the year. The beginning of this year has been very similar. In January, when the market was selling off due to low oil prices, we saw investors take money out of the market. However, late in January, when oil prices started to rebound, bond prices started to rebound, and investors flowed back into the market. It's very typical, and I think we'll see that continue throughout the year. In terms of how we're going to weather that, we're going to do the same things we've been doing for quite some time. We've been employing a barbell strategy where we hold cash into MyG credit. We also overweight a single B and triple C part of the market to offset the drag from holding the cash. And we underweight the middle or double B part of the market. This helps the portfolio in a couple of very important ways. With liquidity being as tight as it is, we don't want to have to trade an illiquid high-yield bond every time we have an inflow or an outflow. So what we do is we let the cash go up and down to meet flows and redemptions, and that's what we'll continue to do. It has a very additive effect in terms of reducing our overall trading costs. I think U.S. supply is going to moderate over time. The differential between Brent and WTI will shrink, but even more importantly, the overall level of oil prices will rise as this occurs. It's going to occur for several reasons. First, rig count, particularly oil rig counts in the U.S., are down by almost 50%. They're actually over 80% down in Canada. That's actually led to, for the first time in a long time, flat production week over week in the U.S. Secondly, companies are reducing their capital and operating budgets significantly. So this helps them get more prepared to deal with a lower price environment. And finally, we do see demand creeping up, and particularly as we come into the all-important summer driving season. So I think this combination of supply moderating, demand picking up, will lead to a balance and absorption of the current excess supply, such that oil prices will probably renormalize later in the year somewhere around $70. And at $70 a barrel with lower cost structures, we think the companies we're investing in are economically viable. You know, outside of energy, I think the most notable theme is that there really aren't any notable themes. That is, spreads and yields have compressed across most other industries, such that you're not really paid to put overweights on in any particular industry. So what we've done is we've actually reduced our overweights to most other sectors, and we're trying to get our alpha by credit selection within the space. We don't know where the next dislocation will take place, and when it does, we'd like to have the ability to opportunistically invest rather than just play defense in positions that we already have. Yeah, I think it should be noted that the record volume of downgrades into high yield really is centered around two credits. They're both emerging market credits, so they have affected the global indices but not the U.S. high yield indices. Now, the first of these is Petrobras, the Brazilian state-owned oil company. And the reason Petrobras has been downgraded to high yield is really twofold. First, they're in the midst of a major CapEx program. That CapEx program has caused their debt to rise significantly, but they haven't started generating material cash flows. We think those cash flows start coming in 2017 and 18 and outward, and we think that they'll be able to reduce debt and repair their balance sheet going forward. The second issue is more of a technical one. The company cannot produce financials right now because they can't quantify the impact of an ongoing investigation into a bribery and corruption scandal by some former officials. Until they do that, they will probably be in violation of their reporting requirements under their indentures. Now, we've seen this happen to other companies, and bondholders do not want to accelerate debt. The company is currently in negotiations with its bondholders should that event happen. We think it will be a non-event. So as they get that behind them, as they start generating cash, we think this company can go back to investment grade, and we think investors are paid very well to be involved. Now, the second credit that really has a lot of dollar-denominated debt is the sovereign debt of Russia. And we think that's a much more troubled and fundamentally challenging story. There's geopolitical headwinds. There's sanctions they're facing. Those sanctions are having a pretty crippling effect on their economy. The economy is clearly in recession. So we don't think that this is a good opportunity to invest at this time. We need to see some catalyst turning Russian prospects around. We don't see that in the near term. Think things could get worse before they get better. So for the time being, we're avoiding Russian debt. Perhaps in the future we will, but for now we're not. Well, to be clear, the U.S. dollar is nowhere near historic highs, so I don't think we're approaching anything like a crisis. Having said that, a rising dollar is clearly a negative for U.S. corporates. It puts the U.S. corporates at an export disadvantage and their competitors at an import advantage. Particularly hard hit are commodity-based companies, whether it's oil, coal, or iron ore. All of these commodities are priced in dollars, so it gives the non-U.S. producers a clear cost advantage over U.S. producers. One of the areas of concern for our portfolio is our overweight to energy. A low oil price for a long period of time could stress our thesis. However, we're comfortable with the portfolio we have together because one of the criteria we had for putting this portfolio together was, can these companies sustain themselves through a long, low oil price environment? We're comfortable they can, and whether it's caused by a rising dollar or not, we think that the portfolio we have can sustain a long, low oil price environment, and we think it will.